Hey, welcome everyone. Welcome to Short Verticals. I'm Brett Crowther. Good to be with you again on another Thursday afternoon. We got a lot to talk about. I'm gonna actually address some questions that I've received that I think will be very interesting to a lot of listeners. And we're going to talk about very short, very short verticals, short short time frame, short verticals. All right. So we'll get right into it. We'll also check, hey, what happened to the trades that we had going from last week, the paper trades that were in the account? Do we need to do any management with them? And then I have several that I want to place today to illustrate this concept of these very short-term, short verticals. And so we'll get right after that. Now, do a big shout out to Cameron May helping out with chat. Thank you so much, Cameron. Good friend of mine. We've been together here at work for man 2 decades or so. It's been a while. It's been a while, but he's a good guy. And so say hi to Cameron in chat. And if you haven't done so, please subscribe, follow us on Twitter. Cameron May CS and mine is Brett Crowther CS. But do follow us over there on Twitter, X, whatever you want to call it. So let's get into it. But let me cover a couple disclosures first off. So do remember the options do carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only, not considered an individualized recommendation. Paper money is for educational purposes only. Short options can be assigned at any time, regardless of the in or out of the money status. Investing does involve risk, including loss of principal. Past performance is no guarantee of future results. And there are some disclosures, also including some option Greek definitions. We'll be talking about gamma today, which is the change of your delta. Also, do note that a stop loss order does not guarantee that it'll execute at the or near the activation price. So it can fail at a different spot than you place it. Okay, so now that we got those things covered, let's go ahead and bring up Thinkorswim and take a look at what's going on. Something weird is going on. Let's see here. Man, everything's wigging out on me here. It's going to pull up. There we go. Okay, we got the SPX up. So real quick, just talking about the overall market, what do we have going on here? Well, initially, and we talked about this, and we talked about this last week, actually. The big run-up that it had, a consolidation could be a potential midpoint of a trend. Will that continue to the upside? We don't know. Right now, down along that support level, and we'll see if this holds or not, and see if it can bounce on the SPX and rally back up and possibly break through the resistance, or will it break this and continue on down? Right now, the momentum is to the downside, and so it's not looking good at the moment. But again, haven't broken through that support, and so it's still kind of there waiting, to see what happens. All right, so let's not get too far ahead of ourselves thinking, okay, this is where it has to go. We really don't know. It doesn't know yet. It hasn't decided or hasn't decided to share with us where it wants to go. And I guess, I don't think it knows what to go because it's a collective result of all of our thinking, right? But as for now, we did have Tesla had a pretty sharp drop. Oops, TSLA. Let's see if we can get this in there. There we go. Tesla had a pretty sharp drop, pulled some things down. In fact, let's go over to the Market Watch and look at the Visualize tab. And we can see if we go by different areas of the market, we can see Google, pulling some things down, Apple down, Nvidia down, Microsoft. I mean, there's just not a lot of green out there, right? And a lot of the bigger companies, the ones that have a heavier weight on the market, are the ones that are in the red. And so even though you have some ExxonMobil and Chevron and some, gas and energy things that are up, Eli Lilly and so forth, it's really not the heavyweights that can really drive the market as much, right? So a little bit with the technology stocks being down and some of the bigger ones, Tesla, obviously that is having an impact on the overall market. And so, but again, has not as of yet kind of broken down. It's still within that range. So with that said, it kind of leaves us on this. Okay, so why do we look at this first of all? We're looking at that to help us identify, which direction to try to place these trades, because if it's bullish, we want to get more bullish type trades. Now, can we put bearish trades on in a bullish market? Yes, and vice versa. However, it just tends to be better, to have the wind at our back, as I mentioned many times. And so that's why we look at this. But right now, it doesn't exactly know where to go. So, we're going to leave it at that and say we can play either side since it doesn't know. It's not up or down. And we're going to get into playing either side. But before I go through and pick out a whole bunch of trades to show you. I want to go over what's going on with the existing trades. So, because trade management is a very important part of trading anything, whether it be long stock, long put, vertical spreads, calendars, condors, butterflies, you name it, right? Even stocks, whatever it might be. Management is a very important aspect. And so here's what we're going to do. We're going to look at, we had PANW is one that we placed. And this one, all we needed to do was be above I think it was what, 315 or something like that. I mean, it's 320. Yeah, 320, 315. So on August 7th, so about 2 weeks ago, we sold this vertical. We got in at 320, 315. So again, we needed to be above 320 by the 31st, I want to say. 31st of July. Oh no, this is the 7th. This is the 7th. And what happened is this one, let's zoom in on this. We can see it's just a little bit better, shall we? I'm going to bring this down. We're not going to use our indicator right at this moment. Okay, so it ran up and is looking pretty good. And then it kind of rolled over in the last 1, 2, 3, 4 days. It has been dropping down. So the question is, what do we do? Do we jump ship or do we just stick in on this trade? And this trade is just down a little bit. In fact, let's go over to the monitor tab and look at PANW. It's down $67 today and $52 overall. Now, what does that tell us? It tells us it's a Thursday, right? Because how many times have we been in this class and it's been on a Thursday? We had something go haywire on us. Well, it was up before today. And so the question is, what do we need to do with this? Well, one thing we could do is we could exit the trade. But still, if it closed right here at expiration, we'd make max gain. So it's just really that it's dropped back down. Now, is there some potential? There's some potential support here for a bounce. Could we give it a little bit more time and see if it rallies back up and maybe close it out for a slight gain or, even a good winner? Well, yeah, and let's actually do that. Let's hang tight because we do have time. That's going to be different from the next one I'm going to show you. This one we do have time to let it possibly bounce and run back up and possibly close up here or something like that, right? So we'll let that one go. We'll let that one go. We're only down just a little bit on that one. The other one, ANET. Now this one was interesting because this one, if you recall when we were talking about it last week, we were looking to get rid of this trend line here. So we got in here, right there, and let's see, does this say yeah, there it is. Sold 3 contracts of the July 31st, and so that's about a week from now, right? That's next Friday, 175, 170. And then what happened is that one dropped down, but it's kind of like our PANW, where it kind of dropped down to where our short strike was. And on this one, I said, let's hang on to that for just a little bit. Why? Because it did have a pretty solid level of support just down there, a little bit lower. And in fact, was that last week? Let's see, that would have been the about 16th. Yeah, so right here's when we were talking last week. I said, you know what? It's right above a level support. We're starting to get a hammer in the class. I said, let's hold on to this just a little bit more because we do have time. We have that ability to be patient and see how this one plays out. Now, had there not been any major level of support or any indication that this might potentially bounce, if this would have been a big strong candle to the downside, that would have possibly changed how we were approaching it because it just looked like there's more momentum to the downside. However, with this, kind of breaking slowly below support, even though that was a big candle, it was giving us some indication of bullishness here. And then so we waited, and this one rallied back up. Now this one's been bouncing around today, and let's see. Now we're actually up $22, and this is where I want to stress that management because this trade was down about $300 2 or 3 days ago. So it was losing significantly. And so to take that by managing it and taking that loss of about $300 to a gain, let's go ahead and close this out now. And why are we going to close this one out now? Well, because we anticipated, this is where we can see the beauty of a short vertical. We anticipated this stock to go like this. We were wrong. It went like that. We were wrong. And yet, we can still get out of this trade at a small profit. And so let's go ahead and right click on that ANET and do create closing order. Let's buy that back. And let's see, I don't know if let's move that more. I don't know if we can, yeah, we'll see. So we can get even a little bit more out of that. Let's go ahead and get out of that. We'll go ahead and confirm and send that off, and let's see that hopefully we'll get filled on that momentarily. Okay, we'll close out of that. Now you'll notice there's one that we don't have in here, and that's Apple. That was the last one we were in last week. And so let's take a look at this one. So we had 3 trades. One of them We're going to wait on one of them. We're exiting, and the other one we already got out. Now, this was interesting because we were talking about this one last week in the class. And if you recall, we put actually an order on that one to get out if it went dropped down for about 30 cents is what I placed it at. And so as it continued to climb, even though, it's still a ways till expiration, it's just getting so far out there that there wasn't much value left on it. And we actually got out for about 30 cents on there. And 30 cents was about 80% of the profit. You see, we paid or got paid $1.65 on that, or $165 per contract. So if we times that by 0.2, that means that 33 cents would be 20% of it, or should I say, when the price dropped to 33 cents, then we would have collected or been able to collect 80% of the profit. Now, why do I bring up this 80%? And the whole idea is that, when you have a vast majority of what is potential out there, like we squeeze the lemon and there's very little juice left. Why are we waiting for that all this time, opening up, giving ourselves exposure? And again, when was this? It was like back in, I think I want to say that's the 13th, 14th, 15th, 16th. I want to say it's any one of these days. Like we're right in here and we're sitting there with almost all the gain, 80% plus gain. We had 80, I got out with 30 cents left. Yeah. So it was a little over 80%. And so there's just not a lot left. And there's still a lot of time for that to go south. And so that's why, it's like, you know what? When we get close enough, we're just going to take it, walk away, and be happy with it. All right. Sam says, hey, covered all my short put verticals with a short call vertical. Break even at best. All right. Appears more people are selling than buying. That is true today. Today they are. Let's see. Let's see. Sorry, is the Mike reading your comment? Okay, I think we're all caught up on that. Just want to make sure I wasn't missing anything. Um, all right, so there's our trades. We had one that we again, one that we got out of with the high profit, one that we waited on, had some patience with, and that played out well for a small profit, and then one that we're still kind of a break even, just waiting to see what will happen with that. All right. So there's our trade management. Now, here's something I want to talk about because I get asked this, and so I thought, I need to bring this up in the class and address it, across the board here, which is that timing. Why do we get in with 20 to 40 days till expiration? Why are we looking for that window? Well, it's really because of the way that the time loss kind of kicks in. And so if you look at the time decay, if we're looking at a graph and we're saying, here's expiration down here. Let me get something a little bit smaller for this. So if we had over here is try this. Here we go. Over here is expiration, right? And this might be 15 days till expiration, and we have 30 days till expiration, and we have 45 days till expiration over here. And this is time decay on the vertical axis, time decay. That looks like a time decay. That's a D. That's not December's decay. All right, time decay. And what will happen is that time decay tends to be, when you get out there a ways, it tends to be a little bit more flat. But as we get closer to expiration, it really starts to pick up and drops off significantly, right? And so that's where we're trying to pick out this window here, where we're somewhere in here where we're really getting, there's still, we're kind of maximizing both sides of it, where we don't want to go out much longer because then we're just not getting a lot more profit potential for the extra time. But if we wait too long, then we're starting to miss out on some of the faster rate of decay, and we don't get a lot of premium. And so that's kind of where that's a sweet spot. Now, does it always have to be the way? No. And can we play different times? Yes. And so, I got asked about, hey, could we play a really short time frame, like a week or 1 day or 2 day or something like that? And the answer is yes. It is possible. But I want to go through, okay, what are the rewards and what are the risks, right? And so let's take a look at a couple stocks. How about V for Visa? Visa. Now, this is interesting. What's going on with Visa here? Is it a double top? Do we have a double? I should do that just a little bit higher. Let me try that again. Do we have a right there double top going on? By the way, this is drawing this line with like a triple lap pen, which is not what you do. You know, these are fat levels of support and resistance. Okay, everyone see the double top? If we see that. Now the question is, what if it were to do this though? What if, I'm going to come in here and draw a little box. If it bounces here and goes back up, it may not be a double top. If it does this number, then it could be something entirely different. Then it could possibly be an ascending triangle. So an ascending triangle is a bullish price pattern waiting for it to break up, right? Where the double top is a bearish pattern looking for it to break down. And so which one is it? Well, BJ, you got it. It's a potential double top, right? It's neither right now. They're both potential. And so we'll have to see. Okay, BJ says, learn that from those short videos you posted. Yes, and so thank you for that. Go over, if you haven't seen them, go over to our homepage on our Trader Talk channel, our YouTube channel, and there's shorts in there. Or even on the homepage, you scroll down a little bit, you'll see a bunch. And I talk a lot about this. But this is one of the things that's very important, is not jumping the gun. Because I see this so much where people say, well, this is look at this, a double top. It is a double top, as if it's a foregone conclusion. It's like, no, it could actually be an ascending triangle too, you know, depending on which way it breaks. And so we got to be careful about getting ahead of ourselves, as I was saying. But now here's the thing, and this can happen in the middle of earnings season. What if we wanted to get in on a trade? Is it possible? Well, let's check it out. Let's go see what we could possibly do here, which I know sounds crazy, but there are possibilities here. And so when is that earnings announcement, by the way? Let's take a look at that. The earnings announcement is, I think it's Monday or Tuesday, the 28th. So that's in 5 days from now. Yeah, it's probably going to be what, next Tuesday or so? So it's coming up. So we wouldn't want to hold a trade over the earnings. And so that basically only gives us a chance to do it tomorrow. I mean, that'd be a 1 day. So let's do this. Let's look at this. I'm going to look at the probability of in the money. And how about, I don't know if this is going to work, but let's see what a 347.50 would be, which is a 27% probability of in the money. And I have delta in here. I mean, they're very similar. These will be very similar. The delta and the probability of in the money are going to be very similar as you get closer to expiration. When you go out quite a ways, I don't know if I can show this, then they tend to separate a bit more. Like 50 and 52, 35 and 38, 64 and 66. They're still similar, but they tend to separate a lot more than, 22 and 23, 31 and 32, 52 and 54. And the further out you go, they'll tend to separate a little bit more. But they're going to be very similar here. So either way, we could look at either one, but basically a 15%, 27% probability of in the money. Let's just see what this does. And so if we go with the 347.50, we're going to click on that and look to sell that. And then buy the 345. Here's a challenge, is there's not a lot in there, right? There's not a lot in there. 35 cents. I mean, the mid on paper money I'd get filled is 49 cents. Now, when you're getting close to expiration, it's less likely to get that mid than when you're, a month away. And so that could be a challenge to make. But assuming we went with even like, let's kind of give it the middle of the mid, we'll go about 35 cents. So could we sell this for 35 cents? And what are the pros and cons? And I want to actually run through a whole bunch of trades, and then I want to talk about the pros and the cons, because there are risks that we absolutely need to understand, okay? So if you're listening to this, stick with me as I go through these trades, and we're going to talk about those risks after we complete this group of trades. All right, and I'm just going to do one contract on these, but what's the risk on this? All right, so if it's a 2.5 wide spread, $2.50, so that's $2.50 minus the 35 cents that we're receiving, that's 215, right? And so that 35 cents divided by the risk of 215 is going to give us a 16% return on risk. And that's not, that's not a great amount, right? A lot of times we're looking for, 30 to 40, something like that, even, get in those 50s. But the other a- aspect of that is the time. There's very, very little time. And so, and by the way, Bogus says, hey, your risk of losing $215. And yes, and that's one of the risks I want to come back to, right? But what is the reward? Well, the reward is we're making, potentially $35 in one day, per contract. Again, we'll talk about that risk. But let's go ahead and confirm and send this because I want to place several of these because I want to monitor these over the next week, and we want to talk about which ones play out well and which ones didn't and what happened with them. And to do that, we need several paper trades as examples. How about this one? MU. Now we could potentially go in there and set maybe a bullish play. It looks like it's bouncing. It came up, bounced off the support level, running back up. And so maybe we do a bull put spread here, looking to capitalize on just some quick movement. Let's see what happens. Let's see what we got. So again, let me hide all this because we don't need that. Going out to tomorrow. Tomorrow we're gonna look for a 30 to 40 delta. We have lots of options in here. So let's kind of grab something similar where we can get. Let's play with a couple. Let's try this 970. That's giving us about a 30, 32, 33% probability of in the money. So, it's a high probability trade. We're going to hit this, and then I'm going to hold the control button and click on the ask. What does this give us? Now, this is interesting because look at this. This is a $1.52, and even the natural isn't too bad, $1.15. All right. So this is actually closer. Like even if I'm trying to make this a little bit less like $1.40 to make it more realistic in getting in on a live account versus paper money, it's still not bad because now this is a 5 wide spread, right? We're selling the 970. So it needs to be above 970 at expiration, which is, wait, do I have the right one up? No, hold on, hold on. Not 970. What am I doing wrong here? Got a credit, delete. Let me try it again. I'm selling 970, 992. Oh yeah, it is up there, 940. Okay, it's up here. So 970, we're somewhere in this ballpark, a little bit below today's action, or right there at the bottom of today's action. So let me go back and recreate that one. For a minute there, I thought, wait, I'm way off on that. All right, so got that up again. Again, I'm going to drop that down, be a little more realistic. Okay, so let's say $1.40. Right now, if we have a 5 wide spread on that, so that's our risk. Again, selling the 970, buying the 965, minus that $1.40, taking the minus there, minus the 140, it's going to be 360, right? We can do that in our head. Whoops. 5 minus 140 is 360. Okay, so now that 140 potential reward divided by the 360 is about 38%. So this one actually gives us a fair amount of money. And so even if this one had like 20, 30 days till expiration, we'd possibly look at this as a potential play. It's bouncing around quite a bit here. That's something I'm going to bring up as a risk. But let's go ahead and place that one because I know the first one, I was getting the feedback of, hey, that's a lot of risk for a little bit of money. This one's actually kind of more in line with what we'd see even with a lot more time, right? And so so that one kind of negates that concern, but there's still more concerns to be worried about. So let's look at NVIDIA. NVIDIA is interesting because it's kind of bouncing around a bit here. So I don't know if it's either bullish or bearish, and where is it going to end up tomorrow? Well, probably somewhere around here, right? So let's go ahead and do this. Maybe we got some hits up here. Maybe we do something on the bearish side on this one. You see that? Because we got a little bit more kind of on the resistance up in here, right? There's some support down here, but it looks like if there's one way to go, it's possibly going to hit a head up here rather than drop down. There's some room to the downside. So let's go ahead and do that. Let's go ahead and see what we can sell on the call side. So again, going over to our 1 day, so we're looking at tomorrow, July 24th, which happens to be a holiday here in Utah. I know it's not elsewhere, but in Utah it is. Let's see, we're going to look at the same deltas. And so where's our delta? We got 22 and 38 from the probability of being the money, or 40 and 22. So we're kind of stretching. Like this is getting really kind of close to at the money, and this is giving us a little bit more breathing room, but it drops quite a bit. Let's just see what we can do with this. Let's go with the 60. So we'll sell the 212.15. So basically we're looking for price action to be below that, right? We're going to sell this and anticipate it being below that, so this will expire worthless. But if it doesn't and it runs up, we're going to buy one a little bit higher. So we'll buy the 215. Where does that put us? 37 cents. Okay. Dang, that's well, but this one's very likely to get filled in the sense that it's very tight, right? Very tight, which is kind of unusual. So this is going to be very similar to that first one we did with, we're about the same risk reward. I think the first one was 35 cents, right? It was 45. This one's going to be, because this one's a 2.5 wide spread. And so 250 minus let's lock it in. Let's just lock it in. Well, 36 cents is going to give us a risk of 214. Yeah, so see about the same thing, right? Let's go ahead and send that one off because that is the same as that first one. And again, we'll come back and we'll talk about that risk reward here in a second. Let's see if we can get that one filled. One or two more. Oh, what about Apple? We played Apple. Could we still play Apple? Apple possibly dropping back, right? Now, I don't know if this is going to find some support here that's going to drop down. So this one we could either play the bullish side or the bearish side on Apple. Let's see what the bullish side gives us. So on Apple, if we do, we got a 16% here, maybe here 29. That's too close. So we got 29% probability here. Let's sell that one with a 29% probability of being in the money, or in other words, a 71% of being out of the money. So sell that one. We'll buy the next one down. Oh, we get 48 cents on that. So not too bad. That's pretty tight. So that's going to be, let me just send this off and then we'll do the math. 48 cents, send that off. So, I mean, this is pretty simple. Like it was a 2.5 wide spread, right? So 250 minus 48 cents is obviously going to give us 202. And so we're looking to make 48 cents or $48. We're risking, $2.02 per contract, or 202 or per share for $202 per contract. And so 48 divided by 202 is going to give us a risk reward of 23%. So that's actually not, way off, especially for being, like 24 hours away roughly from expiration, right? And so we're kind of getting this range of plays. I have, let's see, we've done 1, 2, 3. Maybe that's enough because I want to go through and explain the risks now and talk about this. All right. So what's the good and the bad? The good of this is that we can potentially make some money very quickly, right? These only have 1 day and then it's done. And we can walk with that money. What's another good thing about this? High probability. I mean, we have a high probability that these will work out. We're talking about 60, 70, almost 80% on these. And so the likelihood of this working out is very high. That's the great thing. What is the risk on this? Well, there's several risks. And so let's make sure we walk through what those risks are. Well, one of them is I want to talk about gamma risk. And let me just pull out something like maybe a different stock will show a little bit better. Let me pull up MDLZ. Yeah, so this is a good one to show gamma risk. And so when we get to close to expiration, what will happen? In fact, let me go out a little ways. Let's go out where we have one. It's like several days out. Let me make this just a little bit bigger. Let's see, look and feel. It's actually difficult for me to teach when it's bigger, but I know it's easier to see. But so it's just because I don't usually have it that big, and so it throws me off. I'm not used to it. But if we want to look at this delta and the gamma column, right? So what we have is oftentimes we're saying, okay, let's look at the delta. We're using that as a proxy for expiring in or out of the money, right? And so when we're saying, okay, here we have a delta of 59. Well, let's talk about a delta of 60. This one has a 55% probability expiring in the money. And this one down here as where's the 60 here? 49% probability of being in the money, which is where they're going to usually be when you're getting when you're at the money. Now, what I want you to note though isn't looking at the delta necessarily, but the gamma. And so when we're looking at and comparing these, we have a 49 or basically a 50 delta, but we have a 7 gamma, which means for the next dollar that the stock moves, the delta is going to change by 7 cents. So we're looking for it to either go down to 42 and become less sensitive, or up to 56, become more sensitive. But when we're looking here, this is saying 56.32. So we're looking for this to drop down. What's 56 minus 32? We're talking 24, or going up to 88. And so this one will change dramatically. And so that becomes very important when we're looking at these out of the money strike prices, like this one here. Let's see, let's go with this 59. Do I have the box here? Here we go. With that 59 strike, we're talking about these two right here. We're looking at this 28 delta, and we're thinking, hey, this has a high probability of expiring out of the money as it sits right now, but very small fluctuations in the stock can really, really alter that delta. So that if the stock were to then drop by $1, that delta would go from a 28 to add those two together. Well, saying they're both negative, that would change it to what, a 52. And it's like wham. So that's your gamma risk. And so gamma risk is something that's very real. You got to be mindful of it. And that's the fact that the delta can come on, and change quickly close to expiration. And so sometimes it gives a false sense, expiration. It'll give a false sense of the probability, the risk on there. Okay. I'm just checking to make sure I'm not missing anything. Let's see, you can close margin. Okay. All right. The other thing I want to bring up is pin risk. What is pin risk? Do we know? What is pin risk? P-I-N, pin risk. I'm gonna move this again. So this is the risk of the stock closing, or the stock being at the strike, like really close to it, right? Right at expiration. And so like on some of these we traded like let's go to our Apple, for instance, AAPL. So in this one, we sold the 317.50. Now the stock is right now at 320. But let's say tomorrow at the close, it drops down, and and right at the end of the closing day, it's at 317.50, 49, 51, 52, 48. It's kind of bouncing around there. And we're wondering, where did it close? Did it close out of the money? Did it close in the money? Because if it's in the money, then someone might put the stock to us, and we'd have to buy the stock at the 317.50. Now potentially it's only at 317.48. And so theoretically, Monday morning, we could turn around and sell that stock, which actually brings up another one, is being between the strikes, expiring between the strikes. Because what would happen there is, in that case, talking about this put, so sent in the money, we could likely get assigned on the short leg, but long leg would expire. Now that might not be a bit, but an issue or not, because so suppose, let's just say that the stock came down, it happens to close at we're looking at those 317.50, yeah. So it closes at 317.40. All right. And so we get put it at 317.50. Well, not a huge deal, right? As long as we had the money in our account, because we're only down 10 cents. And then Monday, we could potentially turn around and sell it at 317.40. But here's the deal. Will it necessarily open at that price on Monday? And the answer is no. Now, it could even be higher. It could run up. It could open up at 318. And then, we actually make money on it, right? That's something that can happen. Maybe it's 318.20. But it can also drop down. Let's just say it happened to drop down to 312. The challenge here is we no longer have the other strike, the 315, to protect it, right? Because before we'd say, okay, the 315 will at least protect us and give us this limited risk of $2.50. Well, that's no longer the case, because that one expired out of the money, and so it opens up to a lot more risk to downside. So that's the scary thing, is if we don't really have this ability to to decide what's going to happen with it, especially when it's right there at the strike price as we get into that expiration. So the pin risk, the gamma risk, the pin risk, right? Closing between the strikes. And another one that I want to bring up, so let's bring up right here, is a liquidity risk. So liquidity risk. And what's the risk of this? And I kind of brought this up that um, as as let's just say closer to expiration, the less liquidity. Less liquidity. Liquidity. Less liquidity, making it difficult to exit. So we may think, hey, you know what? If it actually goes against me tomorrow on Friday, I'll go ahead and get out. Well, the liquidity dries up, and so we could put an offer in, but it may not be picked up, and that's a big concern, right? And so these are the things we need to be thinking about. So really, what it leaves us at is we're in this spot where it's kind of like an all or nothing. You know, if we're getting in this trade, we're thinking, okay, you know what? We're going to just expect this to go into expiration. We're not going to be thinking about getting out, and it takes away that what we did with was it ANET? Yeah, with ANET, it takes away that ability to say, okay, it came down, we'll wait and we'll let it run up, and then we'll go ahead and get out, right? We don't have that luxury. You know, if it goes against us, it goes against us, and it's done. And so, um, now, but again, the good side is if it just kind of stays that spot, or goes in our direction, or even slightly against us, we can make a pretty good, relatively speaking, a pretty good chunk of money in a very, very short time frame. But we have to understand the risks. Now, some of those we looked at, you could see that sometimes, we're receiving 35 cents and our risk was $2.15. It wasn't a real great income, but some of them actually were pretty good. And so that's where you have to think, okay, if I get enough, is it worth it? Now, one thing, this is going to be surprising because I wanted to bring this up in earnings season, because a lot of times when we get into earnings season, this is not a time to do it. But here's a crazy thing. So listen to this, is generally speaking, now, of course, nothing's 100%, right? But generally speaking, stocks will actually tend to slow down going into earnings. And so something like this can actually work well when you have an earnings announcement like on a Monday or a Tuesday following that expiration, because the stock will actually tend to not, the volatility tends to tighten up. Going right into earnings is where it gets quiet, and then it pops right after that, right? Now, on the option, it's a different story. It's a different story. The option chain, the next cycle can have a higher implied volatility, but the actual movement of the stock, the volatility of the stock movement itself, tends to dwindle going into that. And so one thing we could actually do, this is crazy, but one thing we could actually do is go into the market watch and go over to the calendar. And like we have this list that I've shown you how to run some scans and find a list of stocks that we could potentially trade that have tight bid-ask spreads and whatnot, and say, let's do this. Let's go ahead and look for who has earnings next week. And so we're kind of looking at this Monday, Tuesday, right? And we want to look at it not in the whole market, but if this, by the way, let's see, did something just freeze? Yeah, it froze there for a minute. What the world is going on? Looks like it's freezing again. I want earnings. So if you have everything on here, take it off and just show earnings. And boy, it's really acting up. Some weird action here. I don't know why it's doing this, but it's really having a hard time. But let me walk you through this. So basically what we need to do is we need to make sure it has earnings, only earnings. We need to go into next week because we want to see what's there Monday and Tuesday. And then we want to look at not the entire S&P 500, but if I can get this to drop down, which is really being slow at, then I actually want to go to, no, that. Sorry, it's the gear I want. My bad. Personal, short verticals. And say, which stocks that I have in this watch list are actually coming up for earnings. And so we have nothing on Monday, but we have, a couple on Tuesday. Looks like it's next week. Is that right? 26th through August 1st. Yeah. So BA, GLW, Coca-Cola. So there's a couple of them, Ford, MDLZ, STX, and Visa. So there's a couple of them that do. We were just talking about Visa. And so that's something that we could actually, like a little scan that we could run to just see if we could minimize movement for these 1 or 2 day options. Does that make sense? that sometimes the earnings, instead of being a hindrance, can actually be a benefit. And we're not worried about the implied volatility because, like Visa was on that list, right? Because when we're looking at the implied volatility, the expiration cycle that we're dealing with isn't going to include it, right? And so the next one will, but ours is not. And so we're not worried about the implied volatility. We're not that because that's not part of this equation, and it's looking to quiet down the stocks. Okay, so there's something that we may want to think about. Now let me just check, make sure we're getting all these questions here covered. It looks like, does the broker exercise automatically if they're in the money? Then yes, they tend to. I mean, nothing's 100%, but yes, that is generally, well, pretty close to that they will exercise it automatically if an option is in the money. Um, let's see. If both are in the money, depending on expiration, you are out the spread and may as well close if you're paying it away. Yeah, yeah. But here's the thing, if they're both in the money, it's they're both in the money, it's a little different scenario. Just be careful about being between the strikes because you got to know that if it's between the strikes, one's in the money and one's out of the money. And so the one out of the money is going to expire and just be gone, right? And so come Monday, that won't be there. So got to be aware of that. How about a week left in terms of time? Yes, there is the possibility of going a week, and I wanted to show you that. We didn't get around to that, but you could look at that and we can see how that is. Um, let's see, the calendar feature is so cool. I had no idea it was there. Okay, you're welcome. Yeah, you're welcome, Jenny. Okay, all right. Looks like we got through the questions. I want to make sure we didn't miss anyone's good question out there. So hopefully I opened up your mind to some different things, right? We talked about the trade management. We talked about potentially some short-term plays. There is good and there is bad. It's just we have to understand the good and we have to understand the risks that come along with it. And you can see some of them made no sense and some of them kind of do make sense. And so it's not that every possibility out there, everything that expires, um, 1 2 day option is going to work. But we found some that did work, and I gave you some ways to kind of search for something that might help you find some. So a lot of stuff covered today. Thank you so much for joining me today. Coming up next, Mike is going to be around for the ThinkScript. So join him shortly. But until I guess next week, pick me up on the comments or on X, and we'll see you then. Take care.